Good day guys, it's Winkelly again. So now we're going to be proceeding to the next chapter, of which is what we call it the liquidity. So which is what we call about, what is it that we talk about when we're talking about liquidity. So basically liquidity is the market liquidity. It's an overlooked topic when it comes to trading. The definition of liquidity is the availability of liquid assets to a market or a company. In every financial market, for every buyer there is a seller, and for every winner there is a loser. Every time you lose a trade, you are adding liquidity into the market. I've always emphasized this, or I've always said this to people, that whenever you press that buy or whenever you press that sell button, just know that on contrary, there is someone on the other side that is buying or is selling. So once you buy, there's someone who's selling. So for market to be a balanced, there must be liquidity, and there must be both the buyer and the seller. Simple as that. It's a supply and demand, and there's nothing to complicate this. You just have to understand that there's a buyer and there's a seller and there's a liquidity. So we are just adding to the liquidity into the market. The currency market is the most liquid market in the whole entire world, but because it is the mostly commonly traded. Whereas the stock market, for example, is less liquidity because it a great deal of investors are holding position for many years or decades at a time. But with the forex or the foreign market, it's traded any day, any time. It's 24/5. So that's when you say it's like Monday to Friday. It's likely to trade Monday to Friday. But if you have traded currencies before, then you are most likely familiar with the terms stop hands or fake outs. This refers to a trader's protective stop loss being hit, causing a realized loss, and shortly after the loss is realized, the price move in the direction of your initial buyers. This occurs because institutional money needs liquidity in the market in order to place their large positions. Stop hands, or liquidity grabs as we call them, or as we like to call them, are the main reason as to why common retail trading methods such as trend lines and chart patterns, double tops, double bottom, head and shoulders, flags, wedges, and everything really work. Not that they necessarily don't work, it's just that they might paint out a picture or at a later stage. So if 95%, okay, here's the thing, if 95% of retail traders are utilizing these methods, then of course institutional algorithms will be programmed to patch stop losses surrounding these chart formations. So if ever they create those patterns, or wherever you just have to know where in the market, where are the stop losses, and that's where you need to utilize it and make sure that you participate in the market. Oftentimes traders have the correct directional bias, yet the price will grab liquidity from both buyers and sellers right before the true directional move takes place. Training your eyes to spot where liquidity may be sitting in the market, it is important when adding confluence to your trades. Similarly to what we have learned about market imbalance in the previous section, we do not trade these methods. We simply use them as evidence when building a case around a potential trade setup. See the next chapter or the next chart example to better understand how liquidity grabs can affect both buyers and sellers. So basically guys, what we're talking about here is whereby we're talking about you need to understand where is liquidity in the market, where is the price, where would like the market will likely to go visit. So whenever you see those double tops, double bottoms, head and shoulders, that's where you're likely to know that this is where the retail this is where now you're going to know that the retail traders, this is where they're going to place their stop losses. But where else with us, we're going to be different and doing things in a different way. So this is how the resistance or the double tops or the seller stops, where they will put them, this is where they're going to get liquidated over here. So you know that if they enter their trade over here, this is where they're going to put their stop loss over here. Same as this ones over here. If they were buying over here, likely they put their stop losses right here, just below over here. And look at what happened here. They were taken out and then price moved in the anticipated direction. Same as here. Now you've placed a stop loss over here. Now your stop loss gets hit, even the order, and then that's what it happens over here. So you need to be aware of what's really happening and where is it likely to happen into the market. So if you were to look over here at the support or the double bottom, the buyers stop losses are very liquidated over here. Same here. This is where liquidity is in the market. This below these lines below. That's why I always emphasize that below an old low you buy and above the old high you sell. Simple as that. So below the old low you buy and above an old high you sell. That's the only simple as possible. That's how you can identify your trade setups or your stop loss or where is liquidity in the market. Because if you can be able to spot where is liquidity in the market, you can be able to trade and be safe that once there's a manipulation, and there's the manipulations whereby like stop loss hunt, liquidity grab, that's where you want to be able to participate into the market. Other than that, this is Wuntle Lady. Please like and subscribe to our YouTube channel, share and comment below with the question, then we can be able to assist you. Other than that, see you on the other side of the withdrawal. Wuntle Lady here, signing out.